Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 3rd, and then we'll see how things look for Wednesday, September 4th. Had some technical damage done in Tuesday's session. Is this a self-fulfilling prophecy? It's widely known that September is usually a pretty negative month for stocks. Doesn't mean it's always negative, but is that what we're seeing starting to happen? There are a number of our charts that are switching over and looking negative. We're still positive, though, in the short, intermediate, and long term. We're working off some of these extreme positive conditions. We already have one extreme negative condition, not a real surprise there, but things are shifting. Is this just a pullback? Are we just going to see a decline? We're not quite sure yet, but this one looks a little bit different. And as I go through all the charts, we'll do an evaluation and see, okay, is there more weakness starting to come in? Now, last week and over the weekend, I did some videos and I started to point out, okay, these are some areas of concern. That's why we look at so many charts and go through so many different things. We can start to see these things develop. They seem to be developing even more after Tuesday. Now we'll see, okay, is this going to shift everything and look normal? Our primary indicators, we have a couple of them that have already turned negative. So we're not really getting a consensus right now as far as that is concerned. Okay, so I do have the SPX Investing Program. You get access to these videos as soon as they're uploaded, where I keep them private until the market closes for that particular day. If you want to learn more about that, there are links below this video that will take you to the website as well as to a video about the program. And you can also email me if you see the need to do that. And as I stated, the video will become public once we close in Wednesday's session, but you'll get early access or access immediately as soon as it's prepared if you're a member of the program. And the same holds true with the weekly videos. I did make them go public a little bit earlier because of the holiday, but usually they'll be made available on Sunday where members have access to them right as I get them done, which is usually Saturday morning to Saturday evening. That's what I try to do anyway. It's 5 videos over the weekend, so it takes quite a while to put those together. Okay, and the daily video is the real hub of my analysis. So all the other videos that I do, you're not really getting a true picture of what's going on. They're meant to supplement everything that goes into the daily video. Okay, let's go back and talk about what happened and then look at some charts. We had a gap lower open. Now, Europe was weak. The futures were pretty flat over the weekend and through the holiday. And then once Europe kicked into gear, that's when things started to turn more negative. That produced the gap lower open that we saw. Prices fell down below S1 at 56.03. So we're falling below that 5,600 level. In fact, we're down still. As I started to record, we're down anywhere from 0.4 to 0.5%, about 0.5% or so. And now we're dealing with the 5,500 level. So we'll have to see. At some point, are buyers going to come in and start to take things higher? Didn't work in Tuesday's session. We'll see if it works on Wednesday. And we got almost to S2 right off the bat at 55.59. Then we slowed down a little bit. Looked like, okay, maybe we're going to build some support here. No, that didn't really take. The prices tried to bounce, but then we ended up falling below S2. We never got close to S3. That was quite a ways away from even the low of the session. And then we found support slightly above the 5,500 level. So we have this psychological round number coming in. And I should also include the 20 and the 50-period simple moving average. They're pretty much on top of each other now. So we do have some pretty significant support about the 20 and the 50-day simple moving averages. I'll show you those charts as we go through this. And we closed slightly off of the intraday low. We were down 2.12%, pretty big move compared to what we've been seeing lately. And we were above average with volume. So the summer is unofficially over. People are back at work. People are going to school. We're seeing volume picking up. And at least the initial start is that they came back didn't necessarily have a good Labor Day weekend or a nice vacation, and so they started selling. All right, so we are tentatively positive now in the short, intermediate, and long term. Now, looking at the chart, yeah, trend-based, we're still looking okay. We still have some support below current prices, but we're seeing some internal measures that we look at. Some are still looking all right. Some are actually starting to switch over and look negative. And we're dealing with inflation and interest rates. Now, inflation, at least as far as the market is concerned, for right now anyway, seems to be under control. It's what's the Fed going to do September 18th? They're going to cut rates. They pretty much have said they're going to do that. The market has 100% probability that will happen. It's just how much are they going to cut rates? If they come in and just cut them kind of as a notion to make the market happy, that would be 0.25% rate cut. Or some folks are actually expecting 0.5% or 0.5% cut at that meeting. And then the geopolitical concerns, things are still kind of wild and going crazy in the Middle East, but that's kind of typical. We'll see if that has some kind of an impact on the markets. It really is not having an impact on oil. In fact, oil is dropping. We're down to 70, and I'll show you that chart coming up later as well. Some comments. Now, this is kind of an outside note, but even though China is huge as far as population and we do a lot of trade with China, what happens to them economically, it can have an impact, but not a huge impact on things in the US. It's mainly Europe and then Japan. Those are kind of the big players. But for a long time, as I've been studying this for decades, I didn't even know China had a stock market. And now they're coming out and they really have some economic issues in China right now. Their manufacturing PMI, it showed a deepening contraction. It's coming in below 50. That shows a contraction of their economy. Also, the VIX, with the down day that we saw, we didn't really change much as far as sentiment, but the VIX is now above 20. That's when it starts to produce negative annualized returns, as I go over in the weekly videos. And then tech and semis did lead to the downside. These were the weaker areas. They've been the leaders in 2024. Now we're seeing some right now looking like profit taking. So we'll have to watch this as it unfolds day by day. Look outside of the S&P, look at lots of different charts, and then try to analyze, okay, where are things finding support? Where are things breaking through support? Are we developing further weakness? And then the 20 and 50 period simple moving averages are providing support. I'll show you that chart. And then we had this mass index thing that's been around for a week and a half or so. Is this what it was trying to tell us? Now, we don't want to take a chart independently. I believe in looking at as much information as you can. If you see something in an indicator, my personal take is you need to confirm that with other indicators. You reach a consensus. You don't just whittle it down to a few little charts and analyze things, in a short period of time. It takes some deep analysis to really figure out what's going on here. And we have to ask ourselves the question, is this reversal beginning? That's what the mass index was trying to suggest. Is that now starting? Okay. And then we do have, on a short-term basis, the slope oscillator still really high, but I have an asterisk here because it's coming down, it's crossing below its moving average. So it's actually turning negative, but still giving us a very high positive reading. And the stochastics, which are a little bit slower because we have different time frames on that chart. We already have the Stoch RSI. It was extreme positive after Friday. Now it's extreme negative after Tuesday. Yeah, that's a pretty touchy indicator. And we still have the TTM squeeze. Now, this is a little slower indicator that we have. It's coming down. It's actually turning negative, but it's still giving us a very high reading. Also, one of the PMO studies areas that we look at is extreme. And this is a slower indicator too. The 10-period moving average of the highs and lows for the S&P, it's still giving us a very high reading. It's going to take a little while for that to pick up any weakness that's going on, which is one reason why we watch that indicator. Then on a long-term basis, the 200 and 150, yeah, they're coming down, but they're still giving us pretty high readings nonetheless. And the scenario hasn't really changed. That was pretty much confirmed last Friday when the core PCE came out, and the market liked that. And that's what kind of was a catalyst for things going up in Friday's session. We didn't break out. We just went to the high end of the range that we've been in for the last couple of weeks. And then what's the rate cut going to be? That's kind of the question. And this Friday, we're going to get the employment situation report. That is a major, it's always important, but it's going to be really, really important this coming Friday. All right. Then the dollar was up. And of course, it's been bouncing back up. I mean, it on the daily chart and weekly chart that we look at, it's gone negative as far as the trend. But ever since that happened, it seems like we've been bouncing back up with the dollar right now. And believe it or not, interest rates were down, even though stocks were down. This is one of those days where we saw both interest rates and stocks going down. We're at 3.84% with the 10-year yield, where after Friday, we had closed at 3.91%. We're still inverted with the yield curves, and we're watching it, especially the 10 to the 2. It's getting close to going back and switching to uninverted or normal, but we're not quite there yet. And believe it or not, sentiment actually went up. And I don't know. I'll see if they readjust these things or what have you. But after Friday, we had been at 63, which is positive, and we ticked up 2 notches to 65. Are folks just thinking, oh, this is just a decline? And because things were looking, I wouldn't say really positive after Friday. I mean, based on our charts, yeah. But we saw some things under the surface that were giving us some concern. And there's one thing that the market will not do. It will not be taken for granted. And when everything is kind of lining up and looking pretty good, that's when you need to worry. When it looks like there's nothing to worry about, that's the time to worry. And that's kind of a sentiment type of way of looking at things. And then we've gone negative. This is one of our primary indicators. We're not trending with the ADX, but the red line has now crossed above the green line. So our trend is now negative until the green line crosses back above the red line. And the ADX is still weakening. It's below 20. It's below its moving average. So we're in a non-trending environment, but we default to the negative side now based on this indicator. And with the down day, our bias is negative. And then I've switched our momentum from, it had been positive, then I switched it over to mixed. Now it's mixed to negative overall, because that's a pretty significant move that we saw down. All right, we got the S&P Global U.S. Manufacturing PMI. I don't have a chart for this, but the takeaway is we're below 50. That's showing a contraction globally. We came in at 57.9, where last time we were at 58. This was the big one here too, and it came in under 50 and weaker than expected. The ISM manufacturing, 47.2. They expected 47.5, but it's up from the 46.8 that we saw last time. And I do have charts to show you of this. Construction spending was down 0.3% when they expected it to be up 0.2%, and last time it was unchanged. So here is the ISM. The total, which is the headline number that we look at, that's in blue, and but it's still above 50. That's kind of the real takeaway from that. The orders are also falling as well. And this is showing some economic weakness at the manufacturing level. And then prices in delivery, where prices are going up and deliveries are going down. Not a real positive report here when you use it in the context of what the market was dealing with on Tuesday. And then import and exports, where we're going up with imports and down with exports. And that's kind of how things have been in the 20th and 21st centuries, as the U.S. tends to bring in more things than they export. Okay, and then looking here on a month-over-month basis, again, the way we should read this is it's below 50, and that's showing a contraction in manufacturing. Construction spending, it's still positive year over year, but it is declining. Another sign of economic weakness. This isn't a real impactful report. We just want to keep an eye on what's happening here. We look at residential versus non-residential, where it's going down for residential and flat to slightly declining with non-residential. And month over month, it had been positive here, going back to 2022 and looking not real strong at times, but it was positive. Now we're starting to see it turn negative. All right, and then Isabel Net has some blog charts here. And you can manipulate this stuff and change it all around and come up with whatever you want to say. But if you take tech, which has been a darling area, not on Tuesday, but in 2024 and even going back to 2023, telecom, or we just call it communications, and then healthcare, which is a more defensive area. You take those together, a percent of the market cap, it's up around the 44% area. You take financials, energy, and materials, and it's down around 25. And so the takeaway from this chart is, should we look at financials? Should we look at energy? Should we look at materials? Well, financials are doing really well. And I have a couple of charts later to show you. And that's encouraging. That means that, at least for right now, things aren't falling apart in the financial sector. Now, it was also looking good back in 2007. And then we, of course, ran into 2008 that led to things. So we want to keep it. That's why we watch this stuff. We don't just use this in isolation. We want to analyze what's really going on here. All right. And then the equity allocation, we're at 62%, which is well above average. Then this is the market hopes for rate cuts, as bullish as it gets. And this is as of last week. This yellow line here is starting to turn back up. And apparently how you interpret this chart is that they're figuring in that we will have a rate cut. And then the probability of a recession. Of course, if we get some weaker than expected economic reports and the employment situation report is weaker, everybody's going to be freaking out about that. But these charts were prepared after Friday, and I take screenshots of them before the market even opened on Tuesday and then on Wednesday. So they're a little bit outdated. Because if things are looking bad, they tend to show bad charts. If things are looking good, they tend to show good charts. But this is looking at the probability of a recession within the next year. And we have the Bloomberg consensus. That's the dark blue. They think 30%. All right. And then we look at market implied probability at 38%. And then the Goldman Sachs forecast is at 20%. Now, you talk to the perma bears and the folks that are kind of doom and gloomers about the future. They're at 100%, and they've been at 100%, and they'll stay at 100%. But that's why just keeping an eye on how people are feeling about things. All right. And then looking at earnings, this is just kind of a way of looking at things going out to the mid-year of 2025, where if earnings continue to go up, we'll get up to 298. All right. That's taking the S&P all together. This is according to Morgan Stanley. And that would give us a multiple of 21.3, which is expensive. All right. And that would put us at 63.50. And that would be, now this is a little day, it's probably up to 14%, almost 15% now. But based on this chart, it's at 12.7%. That means we still have upward momentum there. The base case is that kind of where we're at right now is at 283. That would put us at a PE ratio of 19, a little bit under that extreme positive reading. That would put us at 5,400. We're still above that for right now, but we would have to decline, well, not as much now, probably a little over 2% to decline to get to that level. Because as I said, when I started recording, the market's dealing with the 5,500 level currently. We'll see if that gets dealt with in the aftermarket or during the market session. And then if earnings start to drop, that would put us at 228. That would put us down to a PE ratio of 18.5, which would take us all the way down to 4,200, which would be a 25% decline. That would be a bear market at that point. When we fall 10% and below, that's a correction. And then when we get down below 20%, that's when we actually go into a bear market. All right. So just an interesting chart here that I found over the weekend. Not an awful lot. People were out doing other things. And it says the percentile of indicators, their level relative performance on a monthly reading going back to 2000, with 100% being the most bearish. And this is just showing, like, we have the PE ratio. This is the last 12 months, next 12 months. This is the Robert Shiller Cape PE ratio, the dividend ratio, and all that stuff. You take all of that, and we're getting very high readings. The light blue areas here, it's just meaning that the market's overextended to the upside. And they're trying to compare it to the top that we saw right at the beginning of 2022. That's when the market topped, and then we went into the bear market after that. So this is not necessarily good news when you look at the different, these are more fundamental ways of analyzing the market. Okay, now this is what I thought is interesting. Now this chart's about a month old, but I came across it on Twitter, X, and it's going to be updated this Friday. These are multiple job holders. And this means people that have two full-time jobs. My goodness. Okay. And then if you got a family on top of that, that makes a third full-time job. And no wonder people are stressed. No wonder people are busy all the time. But this is a very high reading way over here on the right-hand side. And we'll get an update after the employment report comes out. But I went, wow, this is really pretty significant. The people have to have two full-time jobs just to get by. One is, anyway. All right, so here is the intraday chart. We saw that surge up. We got to the high end of the range after Friday. Well, then the weekend happened, and nothing really geopolitical happened that was all that impactful on the market. But then when Europe opened, things started to get weaker. We gapped lower. We quickly went down below S1. We came down close to this S2 level. It looked like maybe we were stabilizing a little bit, but then we came down to S2. That ended up providing some kind of support for a while, but then we broke down below that. S3 was way down below where we are here. And we came down about to the 20 and 50 period moving averages and then bounced a little bit off of that going into the close. All right, so this is kind of what shows it here. We were flat. This pinkish area, this is the over the weekend that happened. And then when Europe opened up, that's when things really started to go more negative. And then, of course, the market picked this up and then just took it to town after that. And we're down, it's not really picking it up here, but we're down anywhere from 0.4 to 0.5% as I record this. And then this is also something that's been a concern to us. We've been seeing where the red line has been above the blue line, even though they kind of shifted places here a little bit. This actually goes back kind of far. But the fact that the blue line's going down a lot faster than the red line, that just means growth is not doing any kind of leadership right now. In fact, it's actually lagging behind. And then we look at the S&P growth to value ratio intraday, where we topped out here about the 20th, 21st or so of August, and we pretty much have been declining ever since then. And here's the end of day chart. Growth was down over 3%, where value was down 2, but a lot less. And it was down more with the mid caps and more with the small caps. So growth just got hammered on Tuesday. And we're going down with our small cap growth to value ratio, our mid cap growth to value ratio, and our S&P growth to value ratio. Not what you want to see in a positive environment. And we're actually falling out of the rainbow now with the growth versus value ETFs here. We've been holding up inside of the rainbow. Now we're starting to shoot down. So unless we find some support and some serious buying comes in, there's technical damage here that's being done to the market. All right, and we came down with the discretionary to staples ratio as well after it was showing slight improvement. Large cap growth, we had been hanging out above the 50-day moving average. We dropped below that. We're still above the 100 though. Looking at our trend, we never did break out of this range that we'd been in. And I posted on the website, that's where I'm putting the surveys now, just to say, what do you think's going to happen? And one of the questions that I asked is, during this week, do you think we'll break to the upside or the downside? Yeah, it's only Tuesday and there's still 3 days left to go. We could naturally bounce back up and recover from this. But the idea was that a lot of folks thought that we were going to break to the upside. Well, at least to this point, it looks like we could be breaking to the downside. And this is where we're turning negative now. We still have the ADX below 20, below the moving average, a weakening, non-trending environment. But now the red line has crossed above the green line. And we see that too with the short-term chart. Red line above the green line in a non-trending, weakening environment. And we're starting to pick up. Now, this is an oscillator, so it takes a while for this to actually, it shows more of what's happening over a few days. But we were above average with volume. We saw that on Friday. That was the end of the month and the end of the week. And we saw it on Tuesday with some pretty hefty selling going on. So looking, and this again is a little bit outdated here, but we're still looking fairly positive with this composite sentiment gauge here at 75.58. And we're starting to get into bearish territory. There's a lot of buying going on in this legal insider transactions ratio. And when it gets above this black line, that's actually where it turns a little more negative. But we're not seeing much of an improvement here with the insider buying ETF. Whenever we have this chart, I also show this chart just as kind of informational. And we really went up with the VIX. We closed above 20, both with the line chart and with the bar chart. And when the VIX goes up, so does the VIX of the VIX. It really shot up with the bar chart and the line chart. We're starting to turn back up. We're not quite there yet, but the momentum for the VIX could be switching back over to positive as measured by the MACD. This is the seasonality. I've been warning about this for a few weeks now, where if we go up with the VIX, that typically will mean that stocks are going down. We just want to be aware of that. And even though we were getting an extreme reading here with the SKU index, which measures out of the money options, this is kind of related to the VIX. We closed up in this red area after Friday, and that was causing us a concern. Well, we're up even higher into this area. Does that mean this move isn't done yet? So again, we don't really use this for direction. We use this to say the market's expecting some kind of a big move right now, and it's even more intense after the decline that we saw in Tuesday's session. And we're going back up with this fear gauge. We're going back up with this other fear gauge. So a lot of fear came into the market. We're going back up with the 1-day equity put call ratio chart. We're going up with the 5-day chart and the 10-day chart. This is more negative. A lot of hedging going on right now. We're coming down with our risk on to risk off ratio. And that's more negative for the market too. And not a big change here where the small caps got shot on Tuesday. Okay, not real surprising. They have a few good days and then it seems like then they don't do good for a while. Well, this ratio actually went up slightly. Even though large caps got hammered, small caps got hammered even more. So we're seeing this ratio going up. And we're still pretty low here with the volatility risk premium. Even with the down day, we haven't seen a real spike in this. We actually saw it decline slightly. All right, now this is still encouraging though. Even with the down day, we're still seeing a lot of new highs were generated here. We're flat with the 5-day. We're still going up with the 10-day. So that's just looking okay for the time being. We did see a little bit of an expansion of new lows, but we saw a pretty healthy advance of new highs. And then our advanced decline ratio, not really falling apart here. We ticked down based on price and volume as well. We've been a little bit concerned that volume has been lagging behind price, where price has been setting highs with this, where we never really did break out based on volume. And coming down, but not falling apart with our advanced decline ratio, both with the 19 and 39 day. And this had been extreme positive with our advanced decline ratio after Friday. It's now coming down. We never did go extreme positive based on volume, and it's now coming down as well. Here's accumulation distribution. Now, this has us crossing below the moving average, and you can clearly see that's not happening. But we're still above the moving average, and the moving average is still going up. So this is still positive with our smart money indicator here, but showing some weakness. And we're starting to come down a little bit, but the red line's going up with the Chaikin money flow. And we're going back down again here with the Chaikin oscillator. This has been something we've been watching. And this is another smart money indicator. And when this is going down as we were going up, that was a cause for concern. But when we look at the 50-period moving average of the new highs minus the new lows for the S&P, we're still going up. Now, this is a slower indicator, so it's going to take a little bit of time for this to adjust if we're actually switching more negative. But for right now, it remains positive. And here's the 10-day. Highs minus the lows for the S&P, still getting a pretty extreme positive reading. And we're just ticking down a little bit with the S&P advanced decline line based on price on a cumulative basis. And we're coming down, but we were lagging a little bit behind here based on volume. We had broken out with price. We never really did break out. We did a little bit after Friday, but not that much. And everything got hit on Tuesday. So we're going down with the S&P. We're also going down with the NYSE advanced decline line, but it's still hanging in there fairly well. It's not really disengaging, even though they're on different scales from the S&P. We look at the cumulative NYSE advanced decline line based on price. We drop below the moving average. We decline, but not massively here with our regular NYSE advanced decline line. Also came down with this other NYSE advanced decline line. And coming down with our common stock on the NYSE based on price, coming down based on volume, but not really too catastrophic, at least yet. This makes you think, okay, this is just a pullback. We're just seeing some profit taking going on here. And we're still looking okay here with the advanced decline line studies for the NYSE common stock, the S&P mid caps and small caps, even though they all declined. And we came right down to the 50-day moving average, which is just about where the 20-period moving average is right now. So far, that support level is holding. That could be seen as positive. Now, if we break through that and close below it, that's going to turn things even more negative. And on the bottom, we're above average with volume here. And we might have overdone it on a one-day rate of change here. Friday to Tuesday, that's the one day, and we went down, and we may have gone down pretty far, pretty fast here based on this. Seeing some weakness here with the condition of the 20-period moving average study. We dropped down below both lines. The longer we stay below this, the more these lines will turn and go down. And we're coming right down to the 20-period simple moving average. That's the red line. So far, this is providing support. We're no longer extreme positive with the boom indicator. We pulled off of that after being extreme in Friday's session, coming down with the 50 and the 200, but still looking positive for right now. This is where we're seeing a convergence. We have the 20 and the 50-period moving averages, simple moving averages, right on top of each other. And that was the support level that was hit in Tuesday's session. Is this going to matter? Are we going to be able to bounce up more off of this? Or if we start to break below it, that's going to turn things more negative. We're no longer extreme with the 20-period exponential moving average study on the S&P, and coming back down with the 50 and also declined with the 200. The Stochc RSI, which was extreme positive after Friday, is now extreme negative after Tuesday. And we're dropping below the midpoint with the Williams percent R, coming down below the midpoint with the CCI 14, declining but still above the midpoint with the CCI 20. And we're coming down fast and furious here with the short-term stochastic, no longer extreme in the intermediate term, rolling over below the moving average in the long short term, and still extreme positive. We dropped negative with the force index. We're dropping below the midpoint with the standard deviations chart. This is something that I was pointing out over the weekend. I've been pointing it out for quite a while. These are stocks in the S&P above their 20-period moving averages. We had come up over 90. It was at 91%. Well, we really dropped down. This was a cause of concern here. Now, if we kind of stay or maybe decline a little bit from here, all right, no problem. We can still maintain a positive stance. But if this really starts screeching and eventually gets down below 50, that is definitely going to turn things more negative. And really coming down here with the study that we look at, above 90, now we're at 76. And we came down with the 50-period moving average, but still above 50. We declined with the 100 as well as the 200. All right, intermediate term, balance of power declining, but still above zero. We dropped below the blue line and the red line here with the condition of the 50-period moving average. So is it going to stay down below this, or are we going to be able to get back above it? Here is the simple and exponential moving averages. Came right down to the 50-day simple moving average. So far, we've got double support there based on moving averages. So we'll see if that ends up holding. And we're shifting over to a more neutral stance here with the go, no go. After the dark blue bars, now they're light blue. Dropping below the midpoint with the highest high value. And we've turned negative now, even though we're getting a very high reading with the TTM squeeze. It really dropped. And so the fact that it turned darker blue is also negative, but we're also still getting an extreme negative positive reading here. Extreme positive reading. There you go. And this was giving us a very high reading, higher than what we're seeing on this chart going back to 2021. And so that was also causing us some concern. We're declining, but still positive with the ease of movement. The Erin, it's still enjoying a 4-day weekend now. And we dropped down. We were just barely extreme positive after Friday with the S&P McClellan oscillator. We declined, but we're still above zero. So the summation index based on price is going up, but we're back to negatively diverging now. Based on volume, we're starting to go down again. We thought this had been rectified after Friday. Now it's come right back again. And we're actually turning negative with the NYSE McClellan oscillator. We've dropped below zero. Really hard to see, but we're just barely turning down with the summation index for the NYSE based on price and volume. And this is also turning more negative. We're declining, but still above zero based on price. We've dropped below the midpoint based on volume. This was something else I was pointing out as we were going sideways. We were seeing a negative divergence here. In fact, after Friday, price went up and volume still was going down. And the PMO still looking okay as far as momentum, but rolling over here. Also still going up based on price, rolling over based on volume. No longer extreme positive with the PMOs that are rising, no longer extreme with the buy signals. We're still just barely extreme with the PMOs above zero. And we've gone from neutral to negative with the Elder's Impulse system for the S&P. We've gone, it's a big one, parabolic SAR, dot on top. This is a primary indicator that has now turned negative. And we're still extreme positive with the slope oscillator, but we're crossing below the moving average, short-term negative. The MACD is still above its moving average, but rolling over. So in the short term, we're seeing some pretty significant weakness here with the slope oscillator, rolling over, but haven't crossed with the other short-term oscillator, the TSI, rolling over with our intermediate term, the MACD, PMO, and PPO, still going up, showing a little bit of rollover here with our longer-term oscillators. And coming down and no longer extreme positive with the Sean trend meter. This is encouraging, though. Even with the over 2% decline, the bullish percent index barely budged. So that just means the rest of the stocks in the S&P are holding up a bit better. All right, and we decline a little bit here with the NYSE bullish percent index, but we're really coming down, although we're still positive with the NASDAQ 100 bullish percent index. These are the mega caps and the large caps and the semiconductors. Declining after being extreme positive with the money flow, but still above 50. Ultimate oscillator declining, still above 50. Really coming down with the vortex, coming up with the red line here. We're still positive, but showing some real weakness currently. And on balance volume didn't shift all that much. We're still above an advancing moving average. And we're just a little bit above 50 with the RSI 14. We've dropped below 50 with the RSI 9. The RSI 9 is shorter term. If we can get back above 50 with both of these, that shows better momentum. If we really drop down into the minus 50 area, that's going to show negative momentum. Copy curve, still positive, but really rolling over right now. Mass index, is this causing some of the problems here? We were going up. That's what's triggering what we saw here. When we crossed back below this red dashed line for the second time, that suggests a reversal. And we saw a little bit of a tick up here with the mass index itself as we were having a down day. Again, I don't like to use just 1, 2, or even 3 or 4 or 5 indicators independently, but we've been watching this for a while, and it could signal that a reversal is occurring. All right, Pring bottom fisher for some reason is still generating a buy signal. Not sure why that's happening. And then the simple moving average study, the open, high, low, close, we came right down here, and this so far has been acting as support. And Ichimoku cloud coming back into the green cloud now, and we're still positive. The blue line's still above the red line. All right. And the green line, even though it's really declining now, is still looking okay for the time being. If we see further weakness and we drop out of the cloud and the blue line crosses below the red line, that's going to turn things more negative. We're still looking okay here. This is a weekly chart of the S&P. Even with the decline, we're still above this R2 pivot point. And coming down here to the 50% fib extension level that may be providing a little bit of support, even though we dropped a bit below that. Now we're turning more negative here with the Heiken Ashi showing a dark candle. We're pointing down and negative with the Kagi chart. We're still positive with the Renko chart. And we're looking more negative here with the 3-line break with the black candle. Long term coming down, but still pretty high with our 150 and 200 period moving averages. And we're negative in the short term. Everything got taken out and shot on Tuesday. The S&P, the mid caps, small caps, and the Qs. Still positive in the intermediate and long term. So stocks are negative in the short term. Bonds still hanging in there based on price. And then across the board, we're negative with commodities and the US dollar on all time frames. And lots of red. Not much Christmas going on here. More like Valentine's Day with red or pink or whatever color you want to see here. We tried to bounce back up a little bit here with the NASDAQ and the S&P, but it just wasn't happening. So this is a lot of the technical damage that we saw being done in Tuesday's session. And we saw tech really down 4.59%. Staples, the defensive area, was up. Real estate, which likes the interest rates coming down, that was up as well. Utilities, another potentially defensive area that we've been keeping an eye on. And healthcare. These were the areas that were down the least. And then we compare the S&P to the equal weight S&P. Both did decline, but the red line's still hanging in there with the S&P, even though they're on different scales. So we actually declined a little bit here as the large caps, semiconductors, the really big companies underperformed. Still looking okay here, coming down, but when we look at the new highs minus the new lows daily chart, we are still positive. And we're coming down. Now the Dow set an all-time high in Friday's session, and it's now down 1.5% off of that all-time high. It's still above this pivot point, still above its 50-day moving average. And we're still, well, we went from positive to neutral here with the diamonds. And coming down to this pivot point, is this going to matter? Pivot points do seem to matter when it comes to the NASDAQ and NASDAQ 100. We're below the 50-day moving average. We were able to get back above that on Friday. We dropped below it and down to this pivot point again here. And also coming down to this pivot point below the 50-day moving average where we had been above it. So we've gone from neutral to negative with the QQQs, with the Elder's Impulse system. We're starting to cross over negative with the NASDAQ 100 momentum. And we dropped below the 20 period. Well, here's the 50. That's in red. And we actually dropped below the 20 period here for the QQQs. So that support hasn't held to this point. And dropping back down underneath this 23.6% fib extension level. Small caps, after looking a little better, well, not so much. They were down 2.8%. They dropped below this pivot point, still above their 50-day moving average, though. And with the Russell 2000 small caps dropping below 50 with the RSI, still above the 50 here. And the momentum is still positive, but rolling over. And we've gone from neutral to negative with the small caps with the Elder's Impulse system. And this actually went up here. Even though small caps got hit hard, tech got hit even harder. And so this ratio is going up. If this really continues to go up, that would be more negative for the tech sector. Mid caps coming right back down and closing at this pivot point and still slightly above its 50-day moving average. We've gone from neutral to negative with the mid caps with the Elder's Impulse system. We came right down here, another moving average. Imagine that. Right down to the 50-day moving average, and we were able to bounce up off of that with the Wilshire. Also, come down to the 50-day moving average here with the total U.S. stock ETF, bouncing up slightly up off of that. So these support levels are holding for now. And why am I showing this? Oh, this is, I get this one confused with the small cap one. Look at how we really spiked up here with Staples to tech. Now, Staples didn't have that great of a day either, but tech had a really bad day. This is more concerning. And if we continue to see this going up, we're going to see a golden cross here with this ratio. And that would be like what we saw in 2022. And the perma bears are just going to be salivating and going, oh, baby, this is leading to the end of it as we know it. All right, and we continued to decline. We were down 3.45% with the FANG index below its 50-day moving average. If we keep falling, we'll be watching the 200-day moving average here. So we're coming back down. We're right at this longer-term trend line for the time being. Are we going to break down below that? Right now, we're just about at support for the FANG index. But the financial sector, even though it was down 0.75%, still looking pretty solid here. And because financials were down, but the S&P was down more, we're seeing a real move up here with the ratio. Now, I went over this in the intermarket analysis video over the weekend, but this really going up, and that is actually more positive for the time being. It just means the financial sector is not falling apart. Apple was down 2.72%, coming back down to its 50-day moving average. And we were down 1.25% with Amazon, still above its 200-day moving average. Microsoft is back to dealing with its 200-day moving average. And look at here, Google down to its 200-day move. So you see, that's why we look at all this stuff and we do all this analysis. Because if the market's going to make a stand, we're seeing some things coming together now. And Google is a big part of that. It's coming down to its 200-day moving average. Meta, just a little bit above its 50-day moving average, but it got hit too. NVIDIA really took a nosedive, down 9.5%. Woo, baby. Yeah, the stock that everybody loves until you hate it. And then Tesla was down not as much. It's right in between its 50 and 200-day moving averages. And Netflix, again, must have put out some bad movies over the weekend. It was down 3.7%. And then looking at a broad market measure, the 5-period moving average of the highs minus the lows, coming down a bit, but still positive. This takes a little longer to adjust. And we're seeing a real disconnect in the short term when we look at US versus world stocks, really coming down with the short-term correlation, maintaining more of a steady relationship with the longer-term correlation. And we're coming all the way down to 70 now. Of course, it's an election year. Politicians want this price to go down, but we're watching it more for geopolitical reasons. Staple sector was up and still looking pretty solid right now. And real estate also was up 0.25%, still looking pretty good. It likes those lower interest rates. So when we look at real estate to the S&P, yeah, it's really showing some improvement. And if this can continue, we might see a golden cross with this ratio. And then looking at the dollar, even though it's in a downtrend, it's been coming back up the last number of trading sessions, and we're coming back above this downward sloping trend line again, showing some improvement there. And the dollar going up could put more pressure on stocks. All right, then 10-year yield was down, and the 10-year based on price was up. Want to keep an eye on that. This is the 10 to the 2-year yield curve. We're getting close here. And we're wondering, is this going to be the week? Because it's been well over 2 years that this has been inverted. Are we going to finally go back to looking normal? Now, you're going to see all kinds of videos. You're going to hear the doom and gloomers coming out and saying, once the yield curves is no longer inverted, that's stocks are going to crash. And that may be what happens. But to say that with a certainty is foolish, because there are times when interest rates can go down and stocks can still go up. We have to know the context of what's going on here. All right, and then we're not really seeing any improvement here with our growth to value ratios, although a little bit with discretionary to the S&P. But the Q's to S&P, down. Large cap growth to large cap value, down. The large caps, mid caps, small caps, down. The S&P to utilities ratio, down. Staples to S&P 500 ratio, up. That's a bit of a concern to us. So what's our outlook then for Wednesday? We're positive, but weakness is developing. And you can see that we're at some pretty significant support levels, not just in the S&P, but across the market. And so we'll have to see if the market's going to be able to bounce up off of that, or are we going to see further deterioration below that? And we're going to get the MBNA Mortgage Applications Index. We get that every week. Trade balance, factory orders, and JOLTS job openings. This might be rather critical, the job openings here, just because we have employment coming out later in the week. And then all the crazy stuff going on geopolitically, in case that has an impact on the markets. And then on Thursday, we'll get jobless claims. And we're going to get the non-manufacturing or services ISM on Thursday, and then the big employment report on Friday. Here's an outline. Okay, why? Okay, this red box is about as wrong a spot as you can imagine. So pay no attention to that red box here on this chart. Okay, and then for seasonality, in September can be kind of a rough month overall. We're up 44% of the time. We're down 55% of the time, going back to the last 72 years. But looking at September 4th, we're positive with the Dow, very positive. Or we're just neutral to positive when we look at the S&P and NASDAQ. Wednesday, based on what happened in 2023, that was the most negative day of the week. But so far in 2024, it's been not the best day. It's been the worst day, but it's been positive, at least based on this. And I'm trying to find the daily Stock Traders Almanac chart, but I just haven't been able to get to that one yet. And just seeing, okay, during all election years, typically we see things holding up a little bit better when we have an open field, which is kind of what we have now. This is where we see more weakness going into just before the election actually happens. And September's historically, going back to 1928, not a good month, nor is October. And September here is negative, but October, based on this way of looking at things, is more positive. And then here's August through October, which you take those 3 months together, tends to be negative. And then this has been updated with 2023 compared to 2024. Are we hitting that time like we saw a year ago? We topped out about the middle to latter part of July in 2023 and just screamed down until the end of October. Are we going to see that same kind of thing unfold this time? And then looking at the how things happen in a non-election year versus a presidential election year, where things tend to see some weakness right about now up until election day. And then here's another new one. Looking at September, going back to 1950 when there's an election year, here's the S&P. Flip a coin, up 9, down 9 out of 18 times with a negative return. So the warning signs, we're keeping an eye on these defensive sectors. And we've been watching these for a while, and it's been kind of boring to watch. And it's like, okay, what is this telling me that I don't already know? Are we starting to see that play out now with the staples, utility, and healthcare specifically? And we're keeping an eye on energy, mainly for geopolitical reasons. We're going up with the 5 and 10-day equity put call ratios. Now, this is where we're actually turning negative with the NYC McClellan oscillator and summation index. That's a broad market measure. And to see that turning negative is a bit concerning. Parabolic SAR on the S&P, that's turned negative, and the momentum for the NASDAQ 100 is now turned negative. And we're just not seeing any help from growth to value or discretionary to staples. All right, then our positive indicators, even though they're positive, the smart money indicators, they are declining. Accumulation distribution, Chaikin money flow, and the Chaikin oscillator. So that's a little bit of a concern as well. But the advanced decline lines, even though they declined, they're still holding up quite well. And the S&P McClellan oscillator based on price is still positive, but it's declining based on volume as well as the summation index. And the Swenlin trading oscillator, volume is also, we're seeing a negative divergence there. Our oscillators are showing some weakness, but they're still positive. And the bullish percent indexes for the S&P, NASDAQ 100, and NYSE continue to be positive, but we're seeing some weakness here in the NASDAQ 100. Ease of movement, declining but positive. Money flow, declining but positive. Ultimate oscillator, declining but positive. Copy curve almost getting ready to cross over negative, but hasn't quite done so. The vortex showing weakness, but still positive. The financial sector, which is a little more encouraging there. So our conclusion, we're positive, but right now it just looks like weakness could be developing. Now we can bounce up off of these moving averages and get all that back and do a lot of damage repair. Okay, that could happen, but if we start to drop below that and we look to close below the 20 and the 50s and all these other moving averages that I showed, then that could suggest more weakness could be developing too. In the short term, we're still positive, but weakness is clearly developing there, as well as the intermediate term. And we're still positive though in the long term. We're just seeing a bit of a pullback with those moving averages. Thank you. I really hope you found this helpful. Have a great day on Wednesday, and I will talk to you in the next video.